In this video, we're going to talk about Aterian, trading under the ticker symbol ATER. We're going to cover the price action over the past few days, the company itself, and any recommendations regarding if you should be buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. Before the video begins, I'd like to clarify about the timing of my videos and the reaction or not of the latest market updates. So most of my videos are recorded and scheduled for the next day. 5 days out of 7, they happen in a trading day. So if there are significant movements during the trading day, obviously they will not appear in the video uploaded at the same time. With that being said, to the extent possible, my analysis will be based on the medium term and the intraday movements. The reason why it shouldn't matter that much is because most people investing in stocks, even in the volatile ones, will keep their positions in for at least a couple of weeks. With that being said, if there are significant stock price movements that happen, which modifies the outlook and the decision-making process, then it'll most likely be mentioned in a follow-up video that happens afterwards. Aterian is a consumer electronic and home appliances company with an emphasis on online retail sales with the assistance of its AI system to help guiding its choice with regards to which items to sell for greater profits. It is based in New York. Its market cap is currently $300 million and its enterprise value is $451 million. This means that the market is currently trading the company at a discount compared to what the company's books values its assets at. It has an outstanding float of 45 million shares and has approximately 144 shareholders. The company's quick ratio is 0.56 and its current ratio is 1.03. What this means is that Aterian will be able to fulfill its short-term obligations, which is a positive news for the shareholders who are investing in the company in the long term. The average of Aterian is around The average trading volume of Aterian is around 12 million shares a day, and the current volume ranges more between 4 and 6 millions a day. It peaks at around 10 to 30 million shares, which means that the dynamic it currently has, it is on the side of short sellers. Its 1-year beta is 2, which means that it's double the volatility of the stock market average volatility at the time, which is normal because it's subject to huge volatilities from both like the fundamentals and the short squeeze. It's amazing to think that just over the past few months, the stock has reached a historical high of $43 before going to a bottom of just above $3. But if you held Aterian over the long term, it would still have made a hefty gain because it was only trading at $1.60 at the time. There's a psychological bottom that has been tested twice. Once on August 21st, 2020, and another time tested almost exactly 1 year later at $6.10 on August 2nd, 2021. Right now, it's trading around the $6.70 to $6.80 level, which is comfortably above that significant support level of $6. Looking at the options, I'm actually a little bit surprised that the options market is very 50-50 on the stock because there is an almost identical number of calls and put options for Aterian with a slight advantage over the put. So what this means is that the market believes that the stock will have a high probability of pulling back at the price level of $7.50 and the $10 because those are the two exercise prices where most of the trading, like most of the volume, is for the options. My recommendation is to hold your positions and to wait for either a further pullback before increasing your position, or at least to wait a few days to see if it stabilizes around the current price level before entering the trade. It's worth mentioning that we're currently in a relatively low region in terms of interest and retail momentum, so it may be a good timing to enter the stock assuming that the price stabilizes there and that it'll go up in future. I would recommend a maximum exposure of 1% of your portfolio and to hold it there until the short sellers are squeezed out. We can see that when the daily short interest falls significantly from where it is now, which is around 25%. Looking at the current environment, I think that we gotta be careful with having exposure in the equity market. It has been predicted to eventually go through major pullbacks or even recession for more than a decade at this point, and that its future outcome depends on a number of elements. First of all, after the QE years and a drastic increase in asset price, following by the corresponding decrease of their yields, we gotta remember that the market doesn't mirror how the economy is doing, because otherwise we would have seen a stagnating market for years. And then 2020 saw another big push in asset prices. This time, not just for blue chips, but also for growth stocks. There are, generally speaking, three explanations. The first one is that more money been printed, and that the real economy has been stagnating over the years. The new money entered the huge melting pot of globalized finance and has been used to just buy shares instead of investment. That was the case for quite a while, but now that QE has been touching its end in North America and in Europe, they are considering to slow down the speed of printing. So in other words, new money and QEs will not play that much of a role in the years to come. This decrease of new money, though, is partially compensated with the geopolitical tensions rising across the world. And the more tensions there are, the more money tends to flow to the US and North America because it is perceived as a safe haven for capital from different countries, especially the ones that are currently seeing turmoils or social unrests. One last phenomenon is the attempt of market participants to protect their capital not just by remaining cash heavy, but to concentrate their purchases in a few specific sectors so that the asset price in those sectors remain high, not only due to good fundamentals, but also because there's a very high chance that the demand will be high. What all these mean for the market, though, is that the degree of uncertainty will increase over the next month and years, especially as the expectation for a recession has been building up even after the great sell-off of 2021. And the recent announcement from the US Federal Reserve about the possibility of a recession, plus the buildup of economic difficulties from abroad, are all good reasons to believe that we gotta be careful with what we own in our portfolio. Generally speaking, a healthy portfolio owns a large percentage of its positions and capital in sectors that are mature and diversified, with predictable cash flows, like REITs, fixed income, and preferred shares. The rest should be invested in growth stocks or to stay cash heavy in case there's an opportunity to scoop the bottom. I think that the current environment does make me believe that there will be opportunities to average down the cost basis. And this is why the initial position should remain small, and small enough so that we can have enough capital to average down when that happens. Thanks for watching. If you like my content, please like, comment, and subscribe to my channel.